Tesla just reported its Q2 earnings, and Wall Street is locked in a tug-of-war. On paper, Tesla smashed revenue expectations with a massive record top-line print. Yet the stock is taking a hit in trading. How can a company hit record sales and still drop? Today, we're dissecting the numbers. We'll look at compressed operating margins and what this split earnings report really means for short-term traders and long-term investors alike. Let's break it down. Let's look at the headline numbers. First, the good news. Tesla generated an all-time record $28.24 billion in revenue for the quarter. That's blowing past Wall Street's expected $25.9 billion, driven by record vehicle deliveries and massive growth in their energy storage division. However, Wall Street trades on profitability, and that's where the wheels hit resistance. Non-GAAP earnings per share came in at just $0.33 per share. That's missing analyst forecasts of $0.49 to $0.54 by a huge margin. When revenue beats big but profits miss, it tells us one thing immediately: cost pressure. The main culprit pushing TSLA stock down is operating margin compression. Operating margin plunged to 1.4%. That's down sharply from 4.1% in the same quarter last year. While vehicle volume hit record highs, average selling prices were lower. Operating overhead compressed the amount of actual profit that reached the bottom line. Tesla is making significantly less profit per vehicle sold. Total GAAP operating income dropped 57% year-over-year, down to $398 million. It's a huge shift in the underlying math. There's a second major factor Wall Street is digesting: capital expenditure, or Capex. Tesla reaffirmed that its 2026 Capex will exceed $25 billion. They're pouring massive amounts of cash into AI compute clusters, full self-driving expansion, and scaling robotaxi infrastructure. This is a classic transition phase. Tesla is deliberately sacrificing short-term margin profitability to fund its long-term AI moat. Institutional investors love AI long-term, but algorithms hate near-term cash flow drag. It's a tug-of-war for the stock price. So, what is the key takeaway? For the short-term trader, near-term volatility remains high due to compressed margins and heavy spending. But for the long-term investor, top-line demand is setting records, energy deployment is surging, and AI build-out is at full throttle. If you're trading price action, keep an eye on key technical support levels as the market digests this earnings report. If you found this breakdown helpful, smash that like button and subscribe. Are you buying this Tesla dip or waiting for margins to recover? Let me know below.